All right, good morning, everybody, and happy Monday. We're back. We're back with Set the Market. I hope everyone's doing well. If you're just tuning in, if you could just quickly give me a yes or something in the chat box there, that would be awesome. And then we're gonna get started here in just a second. Very good. Okay, let's get started. I would say without any further ado, let me just see if I'm missing something. No, I think we're good here. Okay. Um, yeah, we're good to go. Cool. All right. Again, good morning, everybody. Happy Monday. It's Monday, October the 20th. It's good to be here. This is our Set the Market morning call. If you've never been here before, I want to welcome you. My name is Serge Berger from thesteadytrader.com. And what we're going to do here, we're going to spend the next sort of 15 minutes or so going through some of the top things on the notepad. If you've never been here before, also, please make sure you subscribe to the channel. It's free still. And if you could also give us a thumbs up, like, and any comments along the way on any videos you watch, that would be awesome. We're back. It's been a very busy week for me the past week. I was pretty much all over the place, from London to New York and Munich and all sorts of places. And I can tell you that talking to investors around those parts, there's a lot of uncertainty in terms of how people think. It doesn't necessarily mean that things should be bad. But I wanted to start off with a little bit of a sentiment check. And that's going to then lead us to talk a bit about, we do have to talk about gold a little bit. I want to talk a little bit about seasonality, which will tie into the sentiment stuff. And then we have to talk about yields. And that would be the order sort of in which we're going to go today, or at least those things we'll check. And I think that's going to give everyone a good start to the week. So let's get started. So I don't really have a chart necessarily to go along with what I'm about to say. So I'll just bring up the S&P 500, which is pretty much everyone's beta, for better or for worse, mostly for worse, because it's risky to have that as a beta. But essentially, when I talk to investors, then what I see is a lot of complacency, right? And that does not mean that we want to be bearish. We want to respect momentum still and trends. However, there's two things that are really critical to understand. We're late in this cycle, right? I think that's something that at least we believe that's been the case. We were late cycle back in 2022, and then it got pushed out by another couple of years because of AI. At some point in the late cycles, and this is particularly when I listen to the quantitative guys, the quantitative strategy guys have insight into things that I think most people don't understand. So when you listen to your favorite TV show, or some strategist, there's a lot of stuff that they don't analyze and research because it's not part of their thing, right? But markets are extremely algorithmically driven. And that layer of analysis, which is why we use momentum and trend as separate tools, that stuff can very quickly lead to some pretty gnarly drawdowns. The economy and the stock market, number one, are not the same, but also the news flow, right? So there's a lot of quantitative strategies that I was getting quite deep into this over the past few months, and it was reiterated to me in London this past week and in New York. There's a lot of stuff happening from if you want to call it from like a pairs trade or correlation trading perspective, that will take very little for a lot of these funds to de-risk in a way that is more or less equivalent to what we saw in April. That's not to be bearish. I want to be very clear, but I just want to make people aware of where the risks are. There's air pockets that can happen. That's number one. Number two, and this is important as well to understand, we have a an incredible complacency trade out there. The complacency trade, and this is a seasonality trade basically, is that the fourth quarter we're going to rally from here on to the end of the year. Listen, that is entirely possible, and I wouldn't be betting against that, at least not yet. However, it is 100% a complacency trade. Like, there's very few people that don't believe that's going to happen. And there's a lot of good reasons for that to happen, right? So you've got underperforming fund managers that need to play catch up, and they're waiting for pullbacks, and they don't come. At some point, they capitulate and they have to buy. To make everyone a fool, right, which the market often does, and everyone's positioned the same way, it would be quite ironic if the fourth quarter rally didn't manifest, right? So again, I'm not bearish. I'm very open-minded. I'm 100% hedged in my equity book because I believe the risks and reward is not very good, but I'm not short, right? From just me personally. So there's a lot of stuff that can happen here from a news flow perspective. So this is our second part here as we head into the latter part now of August. Obviously today is October. We're now obviously here on the 20th of October on a Monday. I think the China meeting's important. We'll see what comes out of the Putin meeting. So there's a lot of Trump stuff basically with world leaders. We do have earnings, of course. And at some point, the government hopefully will reopen sooner rather than later. And then we'll get more economic data, which gets me to the second major point. So to summarize the first major point, a lot of complacency and a lot of people believing that because the news flow is good, that the market can't go down. If you look at some of the major drawdowns in markets, plenty of them, not all of them, but plenty of them had almost no news, whereas someone just became a forced seller for something, right? So that risk is there, and that risk increases in late cycles, okay? So that's one, just a quick feedback from my week and a half or so of travel here, back and forth, which gets us into the government data and that kind of stuff. And so obviously the U.S. government's still closed, but we do have something setting up that to me is increasingly becoming a very high conviction trade for me personally. I've shown this before, but I think we're getting closer and closer to it working out. So what we're looking at here is a chart of 2-year yields, and I made a video on this as well that's going to publish later on today. Some of the greatest money by hedge funds have been made by trend following the bond market through the lens of yields, right? So basically through futures or options, either up or down. Because it typically is a very low volatility way of making money, which is great. And it's a great trend following move, and it can have momentum as well. And so what you're looking at here, for those people that are new to this kind of stuff, you're looking at the yield of the 2-year Treasury note, okay? And I'm going back for the past 25 years, which for purposes of this illustration is probably enough. And you can see that over the course of time, every time that yields ran up high, they at some point mean reverted. We're once again at that point right now where I drew those blue lines. You can see we're just about to break down in yields. The Fed is in my view likely to cut rates, even though it doesn't make that much sense from an inflation and growth perspective. But particularly if Trump gets his way and he installs a Fed chair that is dovish, the market will sniff that out, more and more the closer we get to that in the spring. And then 2-year yields should drop. How far should they drop? I don't think we're going to go back into the ones, but maybe we get down to 2.5% or so. That's still a big move, right? The big difference for those people that are paying attention, as far as past cycles are concerned, I still think we're going to make higher lows in yields. So in other words, higher inflation for longer, but that doesn't mean that we can't have yields go down because the economy at some point is going to slow, and because the administration wants to get rates below the rate of inflation, so that they can sort of inflate debt away. Number one, and number two, we need to, again, they want lower rates so they can basically refinance the debt at lower cost, which makes a lot of sense from that in isolation from a market's perspective. So how do you trade this? It's really not that hard in terms of the conceptually. It basically means be long 2-year note futures, right? Not a recommendation, just information. One can be long options like on something like the SHY ETF. So basically, if I'm saying that yields go lower, I'm thinking that price goes higher in bonds, right? On the short end. This is really important. This is the short end of the yield curve. So something like an ETF like SHY would be one that I think would go higher on that. One can use leverage with something like this and use options. It's important to know that this is not a day trade. It's not even a swing trade, but it's a position trade that I think is going to play out for the month through the lens of a few quarters, right? This is not tomorrow's trade or the trade for the next few weeks, right? This is a multi-quarter trade that I think is going to work out. So I want to be either long 2-year treasury futures and roll them or something like that, or be long something like SHY and options on that. Again, price going up in bonds on the short end means yields go lower. So when we go back to our 2-year yield chart, that's what I'm talking about, right? I'm talking about yields going lower. That's basically what means price going higher. So if there's any questions on that, I'm happy to get back to it. But this is, I think, an important point here to make this morning because it's something I'm looking at very closely. So that's that. Also, last point on this, it's a very asymmetric trade risk, which means the government or the Fed either cuts rates or kind of leaves them where they are. And if they leave them where they are, then the 2-year yield is not going to go up a lot. So it's not that catastrophic, right? The Fed is probably not going to hike rates, right? So it's unlikely the Fed will hike rate unless the data component changes completely. But that seems not unreasonable, unlikely right now given what we're seeing. That's why I'm saying it's asymmetric, meaning the amount of money we can make versus what we can lose is looking very good. Okay, so that's that. If I confused everyone right now, then I apologize. But to me, this is the kind of stuff we look at because this is the low volatility stuff that has trending favorability and has very deep rooted cycle analysis in it. Is the kind of stuff that we like to focus on because this is the kind of stuff that we can put money behind as opposed to some little dinky trade on a stock that may or may not have a little breakout or not, right? Those are trades and those are great, but those are not the kind of things you put a lot of money behind. This is the kind of thing that can be allocated to. In my view, again, that's just an educational thing. Okay? Next thing, and this is a big one as well. So what you're looking at here is a 3-line chart. You can see 2 lines that are going up sharply. One of them is the price of silver. The other one is the price of mining stocks. Silver's mining stocks, gold mining stocks, all sorts of metal mining stocks, okay? So the price of silver, I could have added the price of gold. I could have added the price of uranium. You guys know we've been all over this trade year to date. We made a big deal about it coming into this year. In fact, let me quickly entertain you again with our year-to-date performance chart that I like to bring up every single morning because I think it's just so damn important. So that's this one here. Okay. So again, you can see what's outperforming this year. No, it's not stocks. It's hard assets, right? Not all hard assets, but the kind of stuff that we've seen perform all year is doing very, very well still. So given that, I think one thing that we could see is we could see something like aluminum, which here is the orange line, start to play in catch up. Now, one issue for U.S. investors is that there's actually not an ETF, believe it or not, that tracks aluminum. There's a London uh, priced wisdom tree ETF. It trades in sterling though. So it means we're kind of resorted to futures on aluminum, or play a stock like Alcoa, ticker symbol AA, which is one of the world's largest aluminum makers. That would be another way of doing that. So I just thought I would quickly share this with you, but I think aluminum has a lot of catch-up potential, so just quickly show you Alcoa. Now again, Alcoa is a company, it's not a commodity, but it's going to ultimately, over the course of time, track the price of aluminum quite well. So Alcoa could be one to watch as well. And honestly, I think that's all I had to say. The only thing I want to quickly bring up again is gold. We still think that gold, again, long term, you guys know the market rover has been, we've made a huge deal about this, pretty much all of last year, right? Starting in the fourth quarter of 2023. I don't think now is the time to buy gold. I think now is the time to basically take some profits along the way. We do expect at some point some sort of a correction in gold, and then I would probably get long again. That's just me. We've started basically going long gold in October of 2023, and then added in January 24. I don't think this is the time to get long gold. So just wanted to point this out. We've been talking about this a lot over the past few weeks for people. Doesn't mean gold's a short, right? It's just it's turned into a bit of a speculative asset in the since going vertical like that, since basically Powell became dovish in August at Jackson Hole. So anyway, I know that's quite the session here today. There's a lot of stuff. I thank you all for being here. It's good to be back. We'll do Set the Market Monday, Tuesday, Wednesday. Thursday I have to go to another conference, investor conference, which is important. So I gather all the information, and then we'll be back here again the Monday after. So Monday through Wednesday this week on Set the Market. We'll see you guys over in Trade Ops, and have a great start to the week. As always, please give us a thumbs up, subscribe to the channel. It's free, and we'll see you guys on the inside. Thanks for being here.